Excess consumer savings in the US will likely be depleted by September of 2023. The large volume of savings in the US has been the primary reason why the US economy has been able to avoid a recession over the last year. And a weak labor market is likely to crush the consumer over the next few months. Hard economic data points like industrial production, which the NBER uses as one of its criteria for determining whether the economy is in a recession, is currently at 0% year over year, and that's been the case since March of 2023. If we zoom out a little bit on this chart, you can see recessions occur when industrial productions dips into negative territory like 2000, like 2007, like COVID here. And the same thing goes for retail sales that is currently at 0% on a year-over-year basis. So the economy is already, you could say, on the brink of being in a recession. Meanwhile, you have the S&P 500 that is up 20% year-over-year and pricing in a massive economic recovery. Today, I'm going to show you the two primary reasons why the US economy is likely headed for further weakness and is unlikely to see a sustained recovery at least anytime soon. Here we cover macroeconomic developments and news that can inform you regarding where to find opportunities in financial markets. If you enjoyed this video, make sure to click on the like button down below and of course subscribe to the channel if you have not already. Now without further ado, let's get right into it. By the way, there's only a few hours left to take advantage of our buy one get 1 month free deal. We're doing this exclusively for Father's Day. Our aim on the website is to provide you with institutional grade research like the one that's covered in this video, but with an actionable investment strategy that you can follow in all types of market environments. So head on over to our website, click on the pop-up, and you'll immediately get access to the deal. Many economists back in 2022 were forecasting that we would already be in a recession by the first half of 2023. And yet economic data has been holding up pretty well. Now, of course, we're not in a strong growth territory, but we're not in a recession. This is what recessions look like. Industrial production goes negative. In all recessions, that has been the case. One of the key reasons behind that has been the post-pandemic savings. You can see this is a chart of the savings rate going back to 1929. In 2020, because of all the fiscal stimulus that we got, actually saw the biggest bump in savings since World War II. So if the consumer has a lot of savings, he's able to weather through all sorts of macro environments, which is exactly what happened after the pandemic. Despite record amount of inflation almost hitting 10%, skyrocketing oil prices throughout 2022, and one of the most aggressive Federal Reserve tightening cycles in history. Despite all that, we see the hard economic data actually hold up pretty well for now. Now, if you remember back in around June and July of 2022, that is when we had peak recessionary concerns. If you look at Google Trends, for example, the term recession reached record interest in June and July of 2022, where many people were very concerned about the US economy heading into a recession, hence why the market was falling very aggressively leading up to that moment. But of course, the recession didn't come in 2022 when most people were concerned about it. It didn't even come in the first half of 2023. The huge amount of savings that we had after the pandemic are the primary reason for that. Consumer savings in 2022, this is a chart that we posted on gameoftrades.net back in July of 2022. It showed that the amount of savings we had post-pandemic were 50 times greater than the average. This blue bar is the average amount of savings that the consumer has had between 1929 and 2021, so almost over the last 100 years, and almost comparable to the savings that consumers had after World War II. So while a lot of investors were back in June and July were worried about a 2008 style rug pull, if you were looking at the amount of savings that people had back in July, you can see that was nothing compared to the financial crisis. By the way, that red bar right here, that was consumer savings leading up to the financial crisis. So 2022 was very, very different to 2008. But the story is a lot different now. If you look at the personal savings rate in the US, in around mid-2021, it began to plummet as consumers began to dip into their savings because of the tough macro environment at the time. So this is what the post-pandemic savings actually look like today. They peaked back in July of 2021 and started to trend down. You can see here in July of 2022, we were still at around $1 to $1.5 trillion. This is indeed in trillions of dollars, by the way. So still a lot of savings for consumers in the US to spend and to actually use as a buffer against a tough economic environment. Now you can see where we are today at $0.5 trillion. And if we assume that we stay at the current savings rate, post-pandemic excess savings will be completely depleted by September of 2023. By the way, if you're enjoying this video, if you like these types of more in-depth macro research videos that lay out all the facts in front of you, make sure to like this video. Also, don't forget to leave a comment down below. We do very much appreciate all the feedback. Now, another key reason for why the US economy hasn't entered a recession yet is because of the strength of the labor market. Now, the unemployment rate has been at record lows for quite some time now, with the lowest unemployment rate since 1969. And so when you have a strong labor market, consumer spending tends to be elevated. This blue line here is consumer spending. You can see as you have unemployment low, you tend to see consumer spending elevated. And that's really what drives the economy over the long run, is whether or not people have jobs and whether they can be productive for society, receive money in exchange for that productivity, and then they can go out and spend. But when you have the labor market that begins to deteriorate, that's when you can have consumer spending begin to move down. That's the typical dynamic that happens during recessions. Labor market weakens, consumer spending weakens. Labor market weakens, consumer spending weakens. Labor market weakens, consumer spending weakens. Now, of course, we are currently witnessing some of the most restrictive monetary policy we've seen in history, really since the 1980s, and that's been because of the surge in inflation. So the Federal Reserve is determined to slow the economy down. And by the way, this is a chart from August of 2022, where we really show the tightness that we had in monetary policy back then that ultimately drives the market into recessions every single time you see financial conditions at this level. If you look since 1969, every single time that we've had tight monetary policy like we had in August of 2022, you see the labor market weaken, not only in the first few months after the inversion, but up to 24 months after the inversion. So between now and around a year to a year and a half from now, the odds are very high that the labor market continues to weaken. And what happens when the labor market weakens? You tend to see consumer spending weaken, and that is a typical recessionary playbook. So I hope you guys enjoyed this video. If you did, don't forget to click on the like button down below and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.